The US stock market is coming to a close for the first half of 2024, and we've seen strong performance, led by, yet again, big cap technology. Many have been looking for that pullback, and they've been waiting some time. But again, I prefer time in the market rather than trying to time the market. However, there's still plenty of reasons to be optimistic moving forward here into the summer, because dating back all the way to 1928, July has been the best performing month for the stock market, for the S&P 500. As a long-term investor, I'm constantly looking for good deals in the stock market. And in today's video, we're going to take a look at 4 cheap stocks for you to consider buying in the month of July. But before we do me a huge favor. Click that like button down below. Subscribe to the channel so you're notified anytime we drop new content. And let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 4 cheap stocks for you to consider buying in the month of July. Beginning with stock number 1, which is Equinix, stock ticker EQIX. Equinix is the largest data center REIT on the market, and if you have joined me regularly for my weekly live show, you've heard me talk about the REIT sector, the interest-sensitive REIT sector. And what do we have on the horizon coming hopefully soon? That is interest rate cuts, which is going to be that pressure release valve for the entire sector as a whole. But on top of that, Equinix has a ton of cloud growth, as well as those 2 favorite letters we see in technology, AI, making it a long runway for this particular company. Equinix has a market cap of $71 billion, and over the past 12 months, the REIT is down 2%. Through the first half, though, of 2024, the stock is down 6%. So with prices still being held down by higher interest rates, now may be a great time to start accumulating shares in this data center REIT. Let's first take a look at the dividend. As you can see here, the company pays an annual dividend of $17.04, which equates to a dividend yield of 2.3%. The company has a 5-year dividend growth rate of 11%, a rare dividend growth rate, and they've been growing their dividend for 8 consecutive years. The company continues to generate a large sum of free cash flow. This is even with the large amount, the billions of dollars they continue to spend on capital expenditures, knowing that strong growth is coming with AI. In terms of valuation, the company has a 2025 AFFO estimate of $37.70 per share, giving them a forward price to AFFO of 19.9 times, which compares very favorably to their 5-year average of 26.5 times. With growth expected to remain around 8% moving forward, in line with the past 5 years or so, we should expect much of that same 5-year average multiple. At that multiple, Equinix shares could reach $1,000 per share, which is slightly above the $944 average price target that analysts have on the stock right now. We are talking about more than 25% upside just in share price to go along with that near 2.5% dividend yield. Total return when it comes to dividend investing. Definitely a stock you want to take a second look at. Now we're going to go to stock number 2, which is Johnson & Johnson, stock ticker J&J. Johnson & Johnson is a healthcare conglomerate, one that is trading near a 52-week low. So the valuation is definitely there. The thing overhanging on the stock is the legal woes. And when it comes to Johnson & Johnson, they currently have a market cap of $351 billion. Over the past 12 months, the stock is down 11%, and through the first half of 2024, shares are down 7%. When we take a look at valuation here in a second, you're going to know why. But I believe a year out, 2 years out from now, you're going to look back at this moment and say, I wish I bought more shares of Johnson & Johnson. Morningstar recently put out a note stating that they believe J&J has one of the widest moats when it comes to the healthcare segment. Of all the great healthcare companies out there, J&J is at the top. They are leaders in pharmaceuticals, and they have a solid medical device segment, one that I believe can grow faster than it has been. Their drug pipeline remains robust. The one thing that continues to hang over this company is those legal woes. Let's take a look at the dividend, and I have to note that J&J is a dividend king with one of the longest streaks of consecutive dividend hikes. The company currently pays an annual dividend of $4.96 per share, giving them a dividend yield of 3.4%. They have a 5-year dividend growth rate of 6%, and they've increased their dividend for 61 consecutive years. In order to pay a growing dividend, the company doesn't only need to generate solid amounts of free cash flow, they need to grow their free cash flow on a regular basis. And when you look at Johnson & Johnson, this is a company that over the trailing 12 months has generated $18.2 billion in free cash flow. Compare that to how much they have paid out in cash for dividends, which is $11.7 billion, giving them a free cash flow payout ratio around 60%. In terms of valuation, the company trades at a forward price to earnings multiple of just 13.8 times. They have a 5-year average of 16 times, so well below that. In terms of price to free cash flow, they trade at 15.8 times, again below their 5-year average of 18.7 times. Let's take a look at EV to EBITDA, which is currently at 13.2 times, the lowest levels we have seen since 2016. Their 5-year average is 16.5. So you have to ask yourself, is a lot of those legal woes priced into the stock? And I certainly believe so, because when you look at company results, revenues continue to grow. Free cash flow continues to grow, yet valuation is near a 52-week low. Analysts continue to see the upside as well, as they have a 12-month price target of $175 per share, implying roughly 20% upside from current levels. If you're interested in knowing all the stocks high on my watch list, or in real time which stocks I'm actually buying or option plays I'm doing, consider joining the Stock Investors Edge Discord group. You can join the free version, or if you want to have peeks into all of my option plays and all of the stocks I'm buying in real time, consider joining the Edge Plus subscription, where you can get right now a 7-day free trial. Check out the link down in the description below. And now we're going to get on to stock number 3, which is Pfizer, stock ticker PFE. And if you are one of those Edge Plus members already, which we have more than 16,000 subscribers at the Stock Investors Edge, then you know Pfizer is a stock that I've recently been adding. I love Pfizer under $30 per share. And they've been through a roller coaster over the past 4 years, as pretty much all of those pandemic-related sales are now completely gone. We are now back to the Pfizer of old, and that may not be a bad thing. The company currently has a market cap of $158 billion. Over the past 12 months, though, shares are down 24%. Year to date, though, they are down 3%. The stock has seemingly found support in the mid-$20 range, and I'm continuing to scoop up shares below $30, as the company has a solid pipeline, and yes, they have their very own version of a GLP-1 drug, one that has caught fire on the open markets. In terms of the dividend, this is going to be your highest yield by far. The company pays an annual dividend of $1.68 per share, which equates to a dividend yield of 6.1%. They have a 5-year dividend growth rate of 4.5% and 13 consecutive years of dividend growth. So with the large reversal in the stock price over the past year, you have the opportunity, as we are about to look at valuation, to buy this stock at a cheap valuation and get that high yield at the same time, making for some great potential in terms of total returns. Speaking of that valuation though, Morningstar rates this stock 5 stars and they have a fair value of $42 per share, well above today's levels. The company currently has a forward PE of 12.1 times, which is below the company's 5-year average of 13.5 times. However, over the next 3 years, as you can see, the average EPS growth rate is about 16%, giving the stock a PEG ratio of below 1, showing extreme value for this stock. And again though, those are estimates, so you need to take that into consideration. In terms of analyst expectations, they too see the upside, as they currently have an average 12-month price target of $33 per share, implying roughly 20% upside from current levels. And that leads us to stock number 4 on our list today, which is the Hershey Company, stock ticker HSY. The Hershey Company is one that I do already own, and one we've talked about in the past. It has been rocked, though, over the past 12 months. Why? 2 main reasons: the evolution of GLP-1, those weight loss drugs, and the second being sky-high cocoa prices, record level cocoa prices. But again, I believe these are more short-term trends. How many times have we seen folks go onto different diets or try different programs? And I know plenty of folks right now that are using a lot of these GLP-1 drugs, and they still eat plenty of junk food. They still drink plenty of soda. As for cocoa bean prices, this is a weather-related issue. Again, a short-term related issue that I can take advantage of at cheap valuations. Hershey's currently has a market cap of $37 billion, and over the past 12 months, the stock is down nearly 30%. However, year to date through the first 6 months, shares are down only 1%. Weather is obviously a short-term problem, but one that I believe Hershey's can overcome. Why? Because they have pricing power. And we've seen this in the company's latest earnings results, when revenues rose nearly 9% year over year, but those higher costs did come in, eating into profit margins for the time being. In terms of the dividend, this is another company with a very solid dividend yield. The company pays an annual dividend of $5.48 per share, giving them a dividend yield of 3%. They have a 5-year dividend growth rate of 12%, the strongest dividend grower on today's list. And they have grown their dividend for 14 consecutive years and counting. Hershey's gives you a great blend of a solid dividend yield and strong dividend growth, a combination I love to see. In terms of valuation, Morningstar rates the stock 4 stars, and they have a fair value of $210 per share, well above today's levels. They trade at a forward PE multiple of 19.1 times, well below their 5-year average of 25.5 times. They traded a price to free cash flow of 14.3 times, again, well below their 5-year average of 18.2 times. And then lastly, they trade at an EV to EBITDA of 13.4 times, the lowest levels we have seen in the past decade. This compares to their 5-year average of 19.1 times. So whichever way you look at, and we've looked at valuation from different angles, all showing the stock looks cheap. In terms of analysts, they're also looking for the upside as they have a 12-month price target of $200 per share, implying nearly 10% upside from current levels. So there we just looked at 10 different stocks from varying different sectors, all looking relatively cheap, some cheaper than others. Down in the comments section below, let me know which of these stocks would you be encouraged to buy here in the month of July. And if you haven't done so yet, make sure you smash that like button down below. Consider joining our Discord, our growing Discord community. And with that being said, we'll see you in the next one. Take care.